Oh, brother, oh, brother, oh, brother, oh, brother. Good afternoon, everyone, and welcome to a specialty episode with your favorite Pico influencer. We're here to see what the Fed's going to do. We're here to basically have them tell us they're not changing the Fed fund rate. We're going to be listening to any indication of what's going on with quantitative easing, and we're just going to try to feel out the vibe, you know? This is going to be a very vibe-centric episode, so I hope you guys are ready for that. I hope you guys are ready to read a couple auras here and there and everywhere in between. Thus far on the day, things are slightly red. There's some green, there's some red. The overall indices, poquito redo right now. But there are individual equities. Amazon's green, Apple's green, Microsoft's green, Meta's green, Netflix is green. Nvidia's red. Coinbase somehow turned green on the day. Oil's red. Actually, oil came back down below 80. Gold's up a little bit, but we're in a hold pattern. We're effectively just below the opening value today on the SPY and the Qs, and that makes sense because we are literally just waiting for Jerome Powell to either shake the markets to the upside or rug the markets to the downside. Time will tell. Now, to clarify, just to set some expectations, we get the FOMC, the Federal Open Market Committee meeting results at 2 p.m., but then Jerome Powell will not be speaking until 2:30, a half hour afterwards. So with that in mind, we're going to have to do some stuff in between those two, but I don't want you to think that Jerome Powell's coming out in 7 minutes when he's actually coming out in 37 minutes. So we get the results at 2 p.m. and then Jerome Powell will be speaking at 2:30. Just to give you guys a little looky-see of the market. The SPY, like I said, pretty much just below its opening value. The Q's a little bit deeper, slight trend to the downside, but honestly, we're just going sideways. Look at this. Look at the 5-minute chart, just sideways. The 10-minute chart, sideways. The 30-minute chart, sideways. This is a classic hold pattern. 5-minute on the NASDAQ. A little bit more down, but still essentially sideways. The 10-minute essentially sideways. The 30-minute essentially sideways. So yesterday we did get hit, and we got hit on just kind of some reports that the Fed, the risk is to the downside with this particular speech. The risk is definitely to the downside, and obviously we're seeing some anticipation of that. But that brings up the very fair argument of, is it quote unquote already priced in? Sorry, I'm like awkwardly low. It's weird that none of you guys told me that. I was like really low there. Actually, should we do it that way? Was that a vibe? Should we just, should we do the rest of it like this? This might be a little bit, we've never tried it this way, you know? Everyone's always like, oh, like what about the proper framing? But what if we just, why is that the proper framing? Why can't this be the proper framing? Maybe we're only supposed to see the heads of people, you know? Like who makes the rules on that? Like maybe we'll just rip it like this. I mean, we could get even crazier. We could literally just do like a little bit. Does my thing even come this low? No, because that's when the camera starts. Like we could just do like an eyeball one. That's a little bit more of a Nick Merckx vibe. The issue with this is it doesn't know what to focus on, so it'd be causing some of my audience members to probably seize, which is not what we want. So all right, let's bring maybe just a mustache. Like maybe just the mouth is focusing. I think this could work. This could be a vibe. This could be a thing. You know. It could be a thing. I don't know. But anywho, we get the results in less than 4 minutes. My question to you guys, before this all gets going, I am fully expecting nothing to be changed with the Fed fund rate. In fact, I could even give you the odds on this. The odds on it are bada bing, bada boom, 97.6% chance that there's no change to the Fed fund rate. If you want to bet on this, you 100% can. Shout out to Kalshi, pinned to the top of chat in the description of the video. You can bet on a ton of things. FOMC, TikTok being banned or not, AI, something with Elon Musk keeping his job. You have Rotten Tomatoes for movies, up, above, or below. This lets you bet actual money on a lot of different things, and I have to say, I am loving betting on weather. I don't know why, but I just love betting on the daily high temperature. I usually go in Miami. I think it's a little bit easier, but I should be betting on the high temperature in New York. My point is that you can bet on all of this stuff, including the FOMC meeting. So this is called Kalshi, Kalshi, pinned to the top of chat in the description of the video. If you sign up with that URL, when you deposit $50, they'll give you $20 worth of credit. So you get $20 of freebie bets if you want to YOLO it on some random thing. I mean, you could bet on Biden's approval rating, a ton of things. But the one that I wanted to show you was closing FOMC. These are all the ones that are closing today. You have jobs numbers, unemployment. You could bet on that for Friday if you want to bet on the jobs numbers. Where was the FOMC one? FOMC. Ooh, what is this one? FOMC dot plot, median move up in the next meeting, above 4.6. Woo. So that's for June. That's a little bit out. Where was was there an FOMC today? Next, you could do the next Fed rate hike before 2025, before 2026. Man, they let you bet on a ton of things. But where was still, once again, the one individually for today? Anyway, you get the point. You get the point that you could bet on a wide variety of different things here. And closing. What other? The Bank of England. Where was the other FOMC one? I don't know. I'm currently betting on hurricanes. Where's mine? I'm currently betting on number of hurricanes this year. I said no to above 12. The Fall Guys Rotten Tomato score, I said yes to above 85. And will the Tortured Poets Department be the Billboard's album of the year? I said yes. That's not a solid bet. I feel like it didn't make as much excitement as I wanted it to. But anyway, I digress. We're just here. We're waiting. And then I actually found two things that I wanted to share with you. One thing is a hilarious update from this morning's stream. And then the other one here was the community notes on the representative of the, I guess, Occupy Columbia group. So we have a really, really funny community note there. So with that in mind, we're going to get rocking in less than 2 minutes. All right, they're already chit-chatting. Do I want to put the volume on right now? I want your guesses here. I'm going to turn that down for the second. What are your guesses on the day? Your guesses on the day, are you bullish or are you bearish? From right now, the SPY is currently, let's just call it 501. Do you think by the time we get to the end of the day that the SPY is above 501 or below 501? Are you bullish or are you bearish? What do you think it's going to be? We're definitely not getting a hike. I'm just asking you, are you bullish or bearish from 501? Above 501, aka bullish, or bearish below 501? What do you think it's going to be by market conclusion today? Bull, bear, bearish, bullish, poll, pump, bull, bullish, flat. All right, so kind of split, but you guys are a little bit more bearish, I would say. But anyway, all right, we're about to get this.
On that, and that always comes up. It is important, but I think it's also very forecastable.
Let's
I don't
go to
think there's going to be
the
any surprises on that. I think really the surprise factors are going to come in terms of like what I call a crisis of confidence at the Fed, meaning that there's a crisis of inflation confidence in terms of what this bumpy path means towards lower inflation. How long are they willing to give it, or do they have to reset the inflation clock now and need to see 3 months in a row?
Right, we're 30 seconds out
of low inflation prints in order for them to regain that confidence. So I think the Fed, the balance sheet runoff,
we are
is
not
going to be
getting
important,
the projection materials this time around.
I think that's going to be just well
baked. That's every other meeting. So we got it last meeting, so we're not going to get a new dot
the same
plot.
question I asked Chris in there, which is, what
Here
would
we
be
go.
the scary words that could come out of this?
Here we go.
I mean, if the Federal Reserve were to say that they're thinking about hiking rates, then that would say not only that we could have higher rates, but also the Fed would be admitting that they somehow got it wrong. I don't think they're going to do that.
Initial drop, then a rip to the upside, then we're right back down. We're moving 50 cents like it's nothing, folks.
Markets would be that they're actually contemplating
doggy.
We're going to come back to the panel in just a moment. Meantime, let's go to Steve Leisman for the decision.
The Federal Reserve leaving rates on hold in the range of 5.25% to 5.5%. It does note a lack of further progress on inflation in recent months.
A lack of further progress. That's not good.
Noted that there had been progress. It says the risks to achieving the dual mandate have moved towards better balance in the past year. Note that they had said before we're moving, so that's another kind of reference to stalled progress on inflation. It repeats that it does not expect a cut until it is confident inflation is moving towards that 2% target. It reduced the quantitative tightening runoff.
Took out yesterday's high.
$25 billion from $60 billion. Pretty aggressive reduction there, and that begins in June. A way to think about this is, if my numbers are right, it's a runoff that had been going at $720 billion a year of treasuries, by the way, down to $300. It left the runoff of mortgage-backed securities the same at $35 billion. Again, that QT goes from 60 to 25 on treasuries and begins in June. That is a cap on the reduction. On the economy, the Federal Reserve says continues to say the economy is increasing at a solid pace. It says job gains have remained strong, repeats that inflation has eased, but again noted that progress has stalled. And I'm going to repeat some statements that they repeated this time around, but maybe now they're perhaps more important. They said the committee strongly is committed to bringing inflation to 2%. They're highly attentive to the inflation.
Is the first move the wrong move? Are they just shaking people out?
If risks emerge. Those have been in the statement for a long time, and maybe now they're a little bit more important, Tyler. Back to you.
I'll give you a few minutes to dig a little deeper into those words and think about the effect of them. Let me come back to you, Jim, and we're going to get back to our panel for some reaction. We're also going to welcome in Rick Santelli and Bob Pisani. Why don't I just go to you, Rick, and get your quick thoughts?
Yeah, give it to Rick.
You know, there's been some volatility in the 2-year, the 5-year, the 10-year, the 30-year, and the dollar index. But net out of the volatility, we saw up yield, down yield, but we're virtually at the same spot as before Steve read the statement. We're starting to drift a little lower, and I think that speaks volumes. Interest rates have come down from some of the peak levels earlier today, but they're up on the year, very close to some of the highs. And if you go back to the last meeting in March, we're significantly higher when we were then. I think that the salient feature here is simple. We have a stagflationary environment. Growth isn't bad, okay, but it is definitely moving a bit lower. The glide path seems to be lower. And
so
we
no
know
rate
that
change
not only
as fully
inflation,
expected.
There's pockets of inflation that are going up, even though we seem to read that.
Oop, shoot. Hey, give us that back. Where was that? I lost it. Where's our boy Rick? Oh, no.
If you look at the last 2-year, 69 billion record size, last 5 years, 70 billion record size. The first primary auction of 10s in February at 42 billion record size. We have, 818 billion now to service the debt, on its way to $1 trillion, and we're at 34 trillion in debt in the U.S. We're 312 trillion debt in the globe. To me, the big feature here is sticky inflation is going to meet rising debt levels, and it's going to leave the government very little wherewithal to jockey around discretionary spending. And this all comes at a time where I know we're cutting back down to 25 billion on runoff, and also, like in Poltergeist, they're back. Buybacks are back. That was part of the Treasury announcement today. So we have QT ramping down, buybacks moving up, even though we're not easing. It's been voiced as a liquidity issue. I'm not sure. Liquidity issue really seems to be synonymous lately with rates going up quickly, but maybe they're going up quickly because spending's
coming
going
back up
quickly.
To that initial pop.
All right, Rick, thanks very much. We'll come back to those thoughts in just a minute. Bob Pisani, let me turn to you with the equity market reaction.
Very small. S&P was down 11. Now it's only down 5. The key sentence here is in recent months, there's been a lack of further progress toward the committee's 2% inflation objective. There's the higher for longer. And the issue is, are rates sufficiently restrictive to keep bringing down inflation? That's what we're not sure of. The bond market seems to think that there might be higher rates coming. The stock market, I can tell you, is very afraid of that.
All right. Well, you guys get the skinny on that situation. Let me just hide that for now and talk a little bit more about what's going on. So the market, well, you can hear all my alarms going off. The SPY is popping to the upside. So the SPY hitting its closing value from yesterday, so officially going green on the day. The Qs are actually not green on the day. The Qs have to get all the way up to 424.51, which is the close and the low from yesterday. So now I understand that the market is popping right now, but if we take a quick walk down history or memory lane, a quick reminder of history. Remember, we vomited into close. So we're still below the lowest value of yesterday. Like, we are red right now, back to red on the SPY, back to red on the Qs. Actually, the Qs never even got into the green. So this dump yesterday, I mean, if we didn't do it and we just had like whatever, an arbitrary like small day, imagine how bad the dump would be right now. The Oh, dude, even this, it's not holding it well. It's just faking a lot of people out. Folks, I do have that position on, and you might be thinking, hey, Matt, you said on your stream this morning, if you're still in your position, things didn't go right. Yeah, that's correct. Things did not go right. I never got a chance to get out. It just, the volatility held so constant. We didn't get enough of a trend for me to get out. So I did sell premium. Obviously, everyone in the Discord knows that. Speaking of which, if you want to be in the Discord, there's a group of people right now actively trading this, talking about it, trying to figure it out, working with each other. Get into the Discord, macros.locals.com. If you look at the second link in the description of the video, you're going to come to this. Make sure the promo code Goonies applied, because that's how you can get in for free. But anyway, my mods will drop this exact link right now, so you can join the Goonie Trading Discord. It's all via locals, and that's how you can get access to everything else. The Piper strategy, the private lectures, the trading competitions, the giveaways. Locals is like kind of the community hub, and that's how you can get connected to the Discord. But if you want to be a premium member for free, make sure the code Goonie is applied. So anyway, check that out. But anyway, they are, hang on, let me go back to this. I'm getting some messages right now from the Discord. So anyway, speaking of the Discord, they know what position I'm in, and I don't know. I haven't even been tested yet. In fact, the SPY would have to get up to 505 to screw me over. Which, is that possible? Of course it's possible. We're at 50, well, we'll call it 502 right now, smacking off the close from yesterday. But right now, I mean, we just went from 500 to 502 like it was nothing. The market sliced through it like it was hot butter. Bonds are in the green. Bitcoin's picking up. So will this hold? That's the golden question. I wish I could tell you with 100% certainty where this is about to go, but it's a tough one. There is a saying with the Fed and Fed meetings and Fed updates of the first move's the wrong move. Then, I don't know, a lot of people like to Monday morning quarterback that one, and they don't tell you what time frame they're on. Do they mean the first second? Do they mean the first minute? Do they mean the first 10 minutes? So yeah, there is that saying of like the first move is the wrong move, but what time frame are you considering the move to be? Obviously, that could completely change it. But anyway, we just got the results. No Fed change, and they are right here. This is a key piece of information. Fed holds rates steady, as predicted, and moves to ease the pace of balance sheet reduction. So remember, they were buying. They've been attempting to unwind that now for a handful of months. And the rate at which they're unwinding, just because things are getting a little bit choppy in the ocean that is the market, apparently they're deciding to slow it down. Now, the way I would interpret that is actually a little bit opposite of the movement we're seeing right now, because if they're slowing down their unwinding, well, that's a little strange. What it means, what do they see that we don't see, that they feel compelled to slow it down? So I'm thoroughly surprised that the last, 9 minutes has been as bullish as it was. I was expecting a bit more chop, but really, to me, this is not good. I mean, the way I would interpret this right now, and I get that I'm saying this in the face of a green market, but the way I would interpret this is, why does the Fed feel compelled to slow down their unwinding? What do they know? What data do they have that suggests, this is not the environment they want to be unwinding into? So the way I would interpret this is not so bueno, but obviously the market as of now doesn't agree with me, because the market is green, or it's green from the moment of announcement, but actually now it's starting to go red, which in my mind makes a bit more sense, but we'll see. I'll set up the alerts. This is not the end of the game. There's a lot more time left in the game. Specifically, Jerome Powell will be speaking at 2:30. His words, every single sentence, is going to be just under a microscope, and he clearly has the capability of swinging the market dramatically to the upside or to the downside, depending on what he does or doesn't say, and also how he says it. So this is kind of, we're almost at a weird intermission right now. It's probably the best way for me to articulate it. We're at the point where we got the result. We're seeing the market's first reaction. I don't really think the reaction makes that much of a sense, and hence that's why we're kind of coming back. I mean, as soon as we get back to 501, it's basically a null move. We started this move at 501, and we're at 501.30. So I would actually argue we have no clear direction right now. We're at the point where, okay, people are like, Is it bullish? Then it got smashed. Then it went back up. Then it got smashed again. Then it went back up. Then it got smashed again. Then it went up a little bit less than normal. And now it's coming right back to where we started. So as of now, we're kind of netting out to zero. What's going to really decide today is Jerome Powell. And look at that. We're going red, which I mean, you guys have been chatting with me in real time. The bearishness makes more sense after that particular development, but that's just one man's humble opinion. It is on. Why is it not coming through as clearly as I want? I just want it to be known that the moon is on. We do have our lucky moon on. So I don't want you guys to think that the trades are going against you because the lucky moon's not on. No, your trades are going against you because you're a bad trader. Those are completely two different things. So the luck orb is on. It's ready to rip. Your trades are bad just because you're a bad trader. I think that makes quite a bit of sense. But anyway, back to the old 15-second chart, the best way to trade here. Things are starting to dive. We're just below 501. Obviously, 500 would be a big technical test, a big psychological test. I don't know if we're going to get there. We would have a whole dollar to go. But the way the market's moving today, I feel like we can move a dollar in the blink of an eye. So I have alerts set up for an intraday breakout and an intraday breakdown on both the SPY and the Qs. Bitcoin is holding. Bitcoin trading at 57.7K. Over the past couple of days, Bitcoin and crypto as a whole has been hit pretty hard. Bonds still holding green. Bonds are up 0.5% on the day. So watching that as well. Lots going on. And fortunately for us, things are going to get even more fun in the next about 28 minutes. Now, as we're waiting for some of that to play out, I am so happy. On the same day I covered a story this morning, I can give you an absolutely hilarious update. So as we're waiting for the market to do whatever, as we're waiting for Jerome Powell to get ready to rip it, I want to remind everyone of this clip. This clip was, for whatever reason, she's the spokesperson of the Columbia protest group for whatever reason. And I don't know why. She's not the most articulate. She's not the most intelligent. And this is a clip after the revolutionary Columbia students, which we're now finding out a majority of them don't even go to Columbia. They are seemingly just, I don't know if they're paid agitators, but they're agitators. More than half the group of 300 do not go to Columbia. So I kind of feel bad for like dunking so much on Columbia students when so much of this does not have to do with Columbia. But anyway, this is the clip that after 12 hours of, I guess, occupying a building, she's saying that food has to be given to them. But then I want to go over the community notes, and then I want to go over another thing that people are finding out. You can't make this up. You really can't. It's way, way too funny.
Why should the university be obligated to provide food to people who've taken over a building?
Well, first of all, we're saying that they're obligated to provide food to students who pay for a meal plan here.
But you mentioned that there was a request that food and water be brought in, unless I misunderstood.
To allow it to be brought in. I mean, well, I guess it's ultimately a question of what kind of community and obligation Columbia feels it has to its students. Do you want students to die of dehydration and starvation or get severely ill, even if they disagree with you? If the answer is no, then you should allow basic, I mean, it's crazy to say because we're on an Ivy League campus, but this is like basic humanitarian aid we're asking for. Like
humanitarian aid. Yeah. The government will get right on that, babe.
Very deliberately in that situation and in that position. So it seems like you're sort of saying, we want to be revolutionaries, we want to take over this building. Now would you please bring us food and water?
Nobody's asking them to bring anything. We're asking them to not violently stop us from bringing in basic humanitarian aid.
After asking for food, they're like, no, we're not asking for food.
We are looking for a commitment from them that they will not stop it violently.
They haven't stopped it yet.
I don't know to what extent it has been attempted, but we're looking for a commitment.
So anyway, this is the absolute genius from Columbia. Very quickly, so this was posted this morning. It happened yesterday. Very quickly, it got community noted. Her claims are misleading. Per Columbia, campus dining is open, and then also humanitarian aid is for saving lives in the most dire situation, violent conflict, natural disasters. The students can leave if they want. So right away, getting community noted. But that wasn't the funny thing. The funny thing is what people are now finding out about her. I did a quick search and found that this lady, who refused to reveal her name, is named blah, blah, blah. I don't really care about giving her name. You could read it. She is a paid instructor and PhD candidate at Columbia studying. This is my favorite part. This is the leader of the I shouldn't call her a leader, the spokesperson of the Columbia Revolution. She is studying the quote unquote theories of the imagination and poetry as interpreted through a Marxist lens. I love it. I love it. No, not even an art major. She just lit it rip. A PhD candidate at Columbia studying theories of the imagination and poetry as interpreted through a Marxian lens. I love it. Of course, that's what she's studying. What else in the world would this person be studying beyond theories of the imagination and poetry as interpreted through a Marxian lens? Love it. She is going to have a PhD. Well, maybe after this, who knows if she's actually, assuming she didn't mess this up completely for herself, assuming she got her PhD from Columbia. If you have a PhD in the theories of the imagination and poetry of interpreted through a Marxian lens, you're unemployable. You are you are not a benefit to society. You are going to get paid on a relative basis of what society values your skill set at. And when this is your skill set, no one gives a shit. This is valueless. So it's just, this is an elite campus. This is apparently some of the people that think they're smarter, more intelligent, and telling us what to do. The same person asking for humanitarian aid 12 hours into a revolution where they can't get they could walk out. They're in New York City, folks. They could go to some of the best dining in the entire world a couple blocks away, and they're like, we need this humanitarian aid, brother. Like, I'm just picturing her in her like army helmet, just like ripping a cig, be like, oh, dude, the Western Front, man, what are we doing over there? This is insane. But anyway, just very happy to share that with you. It's only in rare circumstances in which I can give you an immediate update to some of the stories we cover in the morning. So that was a hot topic, and I figured this was a good time to cover it as we're killing a little bit of time waiting for our boy Jay Powell to take the mic. If you guys are joining in right now, our boy Jay Powell, chairman of the Fed, Jerome Powell, he will be speaking, except he's speaking at 2:30, so we have about 12 minutes left. We did get the results at 2 p.m. At 2 p.m., we were told, surprise, surprise, no change to the Fed fund rate. It's not a surprise at all. But what is maybe a little bit of a surprise, but I think most people predicted it, they are slowing down the rate of which they're like doing the balance sheet runoff. As in all the stuff that they were buying circa 2020, 2021, they bought it all, and now they've slowly been selling it. I believe at the peak, we were buying $120 billion of stuff, of goodies every single month. Then they were trying to do the runoff at a rate of about 90 billion. You might want to fact check me on that, but I believe my memory serves correct. And now they're slowing down the rate. So they were buying, they stopped. Then they're like, okay, we should start selling. And they ramped that up. And then we were coasting at 90 bill. And now they're like, once again, I guess, deciding to slow it down, which I think is concerning. I mean, I don't know why the market would be stoked about the Fed slowing it down, because they're slowing it down for a reason. And if they're slowing it down for a reason, when inflation is still bad, it can't be a good reason. That doesn't make sense. It's one thing if you're slowing it down because you're like, guys, we crushed inflation, we're good. Like, hey, we're just like, there's no sense in us like rushing this or anything. The fact that we're still actively battling inflation, and then the Fed's like, oh yeah, by the way, we need to slow this down, tells me something's a little suspect. But that would just be obviously my own interpretation of what in the world is going on. The SPY popping a little bit. So we popped, we dropped, we popped again, we dropped again, we popped. Now we're having a little bit more of a pop. But really, this all started at 501. 501 is the line in the sand, at least with respect to the SPY. And we're right now at 501.50. So we're up about 50 cents. The Qs, all the party started at, we'll call it 422.5, about 422.5, and we're at, once again, up about 50 cents. So that's where, excuse me, that's where we're at. But this is by no means the end. This is by no, the Qs are starting to go a little bit. The SPY is maybe a little bit behind it. Bonds are holding nicely. bonds are doing their job today. Bonds kind of went down, started to catch a bit around 11.15. I'm actually almost more interested in how this is going to impact bonds. Are bonds going to keep ripping, which could add a little bit of relief to the recent market sell-off? Let me show you here on the daily. We did get the upside gap fill. So if you were playing that, which, I mean, little degenerate of you to play today on an FOMC meeting, but the SPY got it. The Qs still have their upside gap fill to 424.51. So if you are bullish on the NASDAQ right now, and I'm not telling you should or you shouldn't be, but if you are and you're looking for like, hey man, like what's a realistic target, you might be looking at yesterday's low, or aka today's upside gap fill, 424.51 on the Qs. Like I said, the SPY already hit it, and that was at 501.98. As we are waiting patiently, DJT not having the best day, down 7.8%. RUB not having the best day, down 4.8%. Tesla not having the best day, down 1.2%. Amazon, after their earnings, even though it's red on the day, it's still up 2.5%. It vomited into close. Apple, green on the day, up 0.36%. Microsoft, after getting trashed yesterday, inside bar, but green on the day, up 1.5%. You have Meta, which if Meta starts to push 446, something like that, I kind of like Meta right here as a bull, because you have well-defined risk. If you want, you could risk either 427.11. If you want to be a little bit more wide, you could risk 414.50. But if this pushes and holds 446, there's kind of a solid upside gap fill play here. I don't know. Call me crazy, but I kind of like the bullish bet on Meta. I really do. I think the risk reward is something that should be, I don't know, at least spark your fancy. Netflix, kind of looking a little weak, almost like this triple bottom here at 545. So waiting on that one. Slightly green on the day. Nvidia putting in another lower high. We had this all-time high early March, and then put in a slightly lower high, a slightly lower high, a slightly lower high with lower lows as well. So it feels like this absolute rip of a party. Nvidia, ever since the start of March, has obviously been taking a bit of a breather. Coinbase also lower highs, lower lows, going the way of Bitcoin right now. Lower highs, lower lows. Obviously, Coinbase and Bitcoin are going to be pretty highly correlated. What else do we have going on? Oil, black gold breaking down. Actual gold taking a bit of a breather, not really breaking down quite yet. Solana, lower highs, lower lows, looking a little bit weak. TLT trying to fight back after getting smoked over the past month. And then Texas Roadhouse hitting an all-time high yesterday. So that's the quick snapshot on the situation, the skinny on the situation. For those of you who are a little bit more visually inclined, here's the heat map of the S&P 500. We have some strength. Microsoft, Google, Meta, Amazon, some weakness, specifically semiconductors and energy. But overall, it's more of a Christmassy vibe. It depends what sector you're in. And even within some sectors, we see some obvious red and some obvious green. No clear direction. No clear direction. Matt, thoughts on IBRX technical and if FDA approval a few days ago? IBRX, I mean, if it's going for FDA approval, that means it's a pharmaceutical play. Yeah, I have no knowledge of this, and I honestly don't care about it. I think the absolute worst sector to trade is pharmaceutical / medical supplies / whatever that you want to call this, biotech, unless you have a knowledge of that industry. If you are trained in whatever, medicine, anything like that, okay, hey, have at it. But if you're just trying to trade this and you don't have a knowledge-based edge of what companies might have better chance at approval, worse chance at approval, I think this is the absolute worst industry to trade, because what's your edge? Your edge might be knowledge, but most of us don't have specific knowledge of the pharmaceutical landscape. So if you do, have at it, but I'm not one of those people. I hate trading pharmaceuticals. It's 50-50. It's just, I find that pharmaceuticals, and this is obviously just my own opinion, but I find that these plays don't really ever care about technicals. It's kind of binary events. FDA approval, Good or bad? Did they pass some sort of placebo test? Good or bad? How did this test go? It's so much of just like binary events of either something positive or something negative, and it either rips or it either gets dumped. So I find that it doesn't follow like technicals at all. That's my opinion. You might be like, no, man, I love trading technicals on pharmaceuticals. And then to that, I would say, are you profitable in the long run? Because I've met very few people who are, and the people who are profitable trading pharmaceuticals have a very specific knowledge related to the industry. They're not trading the technicals on it whatsoever. It's the only medicine on the market that I've heard Merck might be buying them soon. Okay, so you're playing rumors. What does that have to do with technicals? That you're literally flipping a coin. I mean, good luck. But I would not trade and or invest on random things you're hearing. That seems, I think you can find a better edge in the market. In fact, I know you can find a better edge in the market. I know there's opportunities in the market that you would have higher odds of success rather than you heard that Merck might be buying them. So you heard a random rumor that a company might be doing something. That sounds like pure guesswork and luck, if you ask me. I wouldn't be taking those odds at all, literally at all. That it just like, I mean, do what you want. It's your money. Obviously, it is your money. The SPY and the Qs just hit a new intraday high. Those are the alerts that are going off right now as we're a couple minutes out from the Powell speech. It's your money, and I wish you best of luck, but I wouldn't even paper trade it. I think it's kind of a waste of time. Yeah, the SPY is taking off. Ooh, the 30-minute right here. Pushing above. We might have an official change of trend. So the 5 and the 10-minute were kind of green, kind of red, kind of green, kind of red. The 30-minute's been red this whole day, but it is popping into the Powell speech. Now, does that mean it's going to hold? I mean, well, we're about to find out. Even right here, we're seeing the Nasdaq is pushing. Let's find out. Let's find out. All right, let me get this set up for everyone. All right, that is not the appropriate size. And also, now I'm probably going to get DMCA'd because they play the most strange elevator music ever. The most strange elevator music in the world. All right, let's get this ready. Let's get this sized appropriately. And let me make it a little bit bigger so you guys don't have to look funny and squint your eyes the entire time. All right, anyway, yeah, we have Powell ready to rip. So as soon as he gets talking, I'll turn on the audio. Obviously, he's going to be right up here. Starts in 90 seconds. 90 seconds. So the market, right, that's 1 p.m. So really the line in the sand is 501. So just from the announcement itself, we're up $2, almost $2 full. We're almost trading at 503. So just shy of $2 on the SPY. But let's see how this goes. Just because we're going up right now, I want to clarify that does not mean we're going to keep going up. I mean, if you've watched any of these with me, multiple times we've seen hardcore reversals. Other times we've seen whatever the move is get even bigger. So if right now, can you statistically, quantifiably say, hey, like we're either looking good or bad from here? You can't say anything. You can flip a quarter. You can absolutely flip a quarter, and that's going to be roughly the odds of how things play out from here, just to be specifically clear with everyone. We've seen massive continuations. We've seen massive reversals, and that's what makes this so fun. What makes it so fun? Ooh, look at, we just hit the closing value. So the Qs are trying to go green right over here in the bottom left. The Qs down by a couple cents, but right at that red-green move, while the SPY's up $1 or AKA 0.2%. We're about to find out. We are about to freaking find out. All right, is Powell going to be talking? Powell, you there, brother? You there, brother? Brother. All right. I know you guys can't hear anything yet. I just don't want to get taken down for whatever this copyrighted elevator music is. but Powell should be speaking now? All right, I have the audio on. I don't think they're saying anything yet. What's everyone's bet? From here on out, is Powell going to tank the market or is he going to rip the market? Where do you think it's going? Tankety tank or rippity rip? Powell, you going to be joining us today, brother? You going to be joining us today, brother? Yes, no, maybe so. Hawkish, you're going to... Wait, are you guys saying rip as in good or RIP as in tanking? What's everyone? Tank. Close the effing door. Oh, here he comes. Here we go. All right, folks, buckle up. Just him literally standing there like, we got to sell.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace.
Right back to where we started.
Policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. But labor demand still exceeds the supply of available workers.
60 cents like it was nothing.
Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate
Bitcoin
at
up, bonds up,
5.25%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment
all
and
over the
inflation
map
goals
today
have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings.
The market's liking this
that are consistent with reaching the appropriate level of ample reserves.
Runoff, less pressure.
We remain committed to
maybe
bringing
it's
inflation
interpreting it
back
as less
down to our
downward
2%
pressure.
Goal, and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country.
Now for part 3 of the show,
is in service to our
the questions.
Mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular. But it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also we look at surveys of workers and, surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that, that policy is restrictive.
Sufficiently restrictive, I guess. Is the word.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that, that the data will have to answer.
So as a follow-up, if inflation continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for...
Expectations are not anchored?
Or anchored.
Or anchored.
Stable, roughly. Would you disrupt that for the last half point on PCE?
You know, I don't want to get into complicated hypotheticals, but I would say that, you know, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Gina. Thanks for taking our questions, Chair Powell. I wonder, you know, obviously, Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. You know, our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask, what would it take?
We're just rocket shipping
we need to see
now.
persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data, answer to that question. That would include inflation expectations, and all the other data too.
Would that be like a reacceleration in inflation?
Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things, but if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Chris.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So on, let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks.
Maybe a little bit of a peak here.
We'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take which would cause us to want to consider rate cuts, and those would be, two of those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably down to 2%, and another path could be, you know, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, you know, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. I mean, is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And For sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably, that's what, or tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply-side distortions and demand-side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can't continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply-side issues that they're facing. And also, even when the supply-side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either either growth or a strong labor market in and of itself would automatically create problems on inflation, because, of course, it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation. And that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. What we've said is that we need to be more confident, and we've said, my colleagues and I today said, that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of confidence. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months data, but this is a full quarter, and I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path than a 2% inflation. That's the signal that we're taking.
Steve.
Yeah, Mr. Chairman, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing, we have put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view, I think, that in fact we didn't gain confidence and that it's going to take longer to get that confidence. But I just think, you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened, and I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in-housing services. So,
if I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates. And this is a plan we've long had in place to slow, really not in order to, to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Craig.
Craig Torres from Bloomberg. 2 questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth. That's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree, it's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it would be appropriate to cut until we were more confident that inflation was moving sustainably at 2%. We didn't get, our confidence in that didn't increase in the first quarter, and in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's, the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting, and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them's further away from goal than the other, then you focus on that one. It actually, it's the time to get back there times the times how far it is from the goal, and that was clearly inflation.
We're almost
so
completely just eating back up yesterday.
And this is what we referred to in the statement.
Volatily going nowhere.
As inflation has come down now to below 3% on a 12-month basis, it's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it. And that's how we think about that.
Claire. Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It would be good if you could just confirm whether or not that's a correct reading.
Unlikely next
and the
policy
Q1
move will be a
GDP
hike.
print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not
the old S
really
word.
Likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your question, your second question was stagflation.
Options going a little bit flat.
I guess
since
I would say I was around
255.
for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have and very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure. And we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say, most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%. And that won't be, so I don't see the stag or the inflation, actually.
The stag or the inflation.
Michael McKee from Bloomberg Radio and Television.
Almost a new
The vice
intraday
chair
high.
of the FOMC said recently that he's willing to consider the idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view? And would
Knocking
that
on the door of
imply
a
that
continuation
maybe
to the
policy
upside?
isn't tight enough?
So I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw.
Options are still cruising. Every time it looks like they're going to take a breather, they just don't.
Productivity run.
It's all zero DTE. All zero DTE calls.
Persistently above its longer run trend. I don't think we know that. In terms of potential output, though, if that's a separate question.
That's crazy.
We've had what amounts to
people are just YOLOing into calls right now.
Significant increase in the potential output of the economy. That's not about productivity. It was about having more labor, frankly, both through in 2023, both through participation, also through immigration. So we're very much like other forecasters and economists, getting our arms around what that means for potential output this year and next year. And last year, for that matter, too. So I think in that case, I think you really do have a significant increase in potential output. But you've also got, you've got more supply, But those people also come in, they work, they have jobs, they spend. So you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that
Dude, so
at this point,
wild.
You're not
This is
really
disgusting.
considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about
80
causing the
cents
economy
in 10
to slow
seconds.
too much than you are about inflation?
Price
taking off?
stability.
No,
trading like a penny
We
stock.
believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive. And, our evidence for that I went over earlier. You see it in the labor market, you see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years. And that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Edward. Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Inflation, employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be.
Dude, options are still just going nuts. Look at all these zero DT calls.
Victoria.
From 2:38 until now, zero DT calls have been going bonkers.
You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly,
if this gets unwound, it will be brutal. But that's a big if.
Between starting to cut in, say, September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. It's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing, and we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then, is there a significant difference between, whether you start
buying, man.
Say September versus December?
These call buyers are nuts.
There's a significant difference
I
between
love
an
it.
institution
Pure degeneracy
that takes into account all sorts of political events and one that doesn't. That's where the significant difference is, and we just don't do
pure
that.
degeneracy.
You can go back and read the transcripts for every. This is
We're
my
still buying calls even on this dip.
Fourth election,
even on this dollar dip. They're like, nah, brother.
Read all the transcripts.
Look at it
and see if anybody
it says green line
in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. if we start down that road, I don't know how you stop. So.
Thank you, Chair Powell. Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wages peaked, wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly.
If these calls get unwound,
the
we dive.
Reading from Tuesday
right here,
it was
this green line.
To have come down, and essentially it was flat year over year, I think, roughly. So
let's see who blinks first. If it can hold, the prices could easily bounce. Who blinks first?
But in
we have some put buyers starting to slowly step in.
Wage increases running higher than productivity would warrant, and then there will be
55 minutes left in the day.
Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Scott. Nancy. Sorry.
Hey, Chair Powell, Nancy Marshall-Genzer from Marketplace. You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well, the thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck and suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8. Now it's at headline peaked at 7.1. Now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes. I mean, I think that restrictive monetary policy is doing what it's supposed to do. But it's also, in this case, unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation and the reason why we're having this conversation.
Dude, these zero DT calls are still not quitting.
Kind of
this is so
with
incredibly
and
phenomenal.
bottlenecks and all that kind of thing. And this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially, there are there are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent, and you can see market rents are barely going up at all. The inflation in those has been very low. But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expect it.
Are they finally taking a breather right here?
Nick Jasinski.
Is this the first break we've been seeing in zero DT call buying?
This is Nicholas Jasinski from Barron's Magazine.
Watch this. Let's see if it keeps trending.
Over the past 3 or 4 years, economies and central banks in developed markets at least have been on more or less the same trajectory. Easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So you're right. I think that may happen, and you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. Their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we'll be careful.
TLT bonds are now dumping
as we approach the decision to cut rates. Whereas I think other
bonds are starting to dump, and options are flattening out.
I think.
Decision time, pivotal moment. Do we keep the party going, or are we giving it back?
I think the economy.
Pay attention to bonds.
Can adapt
pay attention to options.
And I think we haven't seen, in addition, for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation, and so they're navigating this pretty well this time.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy, or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy.
Zero DT is starting to pick up a little bit right here.
Supply
slight
problems,
uptick.
supply side problems,
2.41 billion
some
now.
Demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without, without significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
You know, I said an unexpected weakening is the way I characterize it. So, you know, and I'm not going to try to define exactly what I mean by that, but you know, it'd have to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. You know, a couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances.
Zero DT calls flat since 310.
Chair Powell, thanks for taking the question.
Seems like
Kyle
the
Campbell
zero
with
DT
American
calls are
Banker.
what's driving the market.
You've said that broad and material changes are needed for the Basel III endgame proposal, and you've mentioned that a reproposal is something that's on the table. As you've had more time to sort of
if we
sit
take
with
out
the public
505
commentary,
right here,
process that,
this
and
low from
understand the options
247, I
available
think
to
we
you,
dump.
Do you have a better sense
But
of
that's
whether
a
a
huge
reproposal will
if.
be
I mean,
necessary?
obviously,
And do you
it's
have
more
a
than $2
timeline in
away.
mind for when you know, some sort of movement will be made on that front, either a reproposal or a move to finalize?
So let me start by saying that the Fed is committed to, you know, completing this process and carrying out Basel III endgame in a way that's faithful to Basel and also comparable to what the other large comparable jurisdictions are doing. We haven't made any decisions on policy or on process at all. Nothing. No decisions have been made.
Bonds are heavy. Yields must be upticking.
That proposal is appropriate. We won't hesitate to insist on that.
And then do you need to resolve issues with the capital proposal in order to advance other parts of the regulatory agenda?
The
or do you
10-year
expect
yield is starting to
make progress on
catch a
those
bid
other,
again.
Agenda items?
You know, there's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Let's go to Mark for the last question.
Last question.
Thank you, Mark Hamrick with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff.
Bonds are heavy, man. How are stocks holding?
And so each reserve bank
It's 'cause of
has
options.
its own
Options are
culture
holding
around
strong.
monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, you know, we have dissents, and you know, a thoughtful dissent is a good thing. You know, if someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking, or do everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, you know, that for most people, most of the time, that'll be enough. But I'm not. I mean, it's not, you know, frowned upon or illegal or against the rules or anything like that. It just is the way things come out. And I mean, I think we have a very diverse group around the people, frankly, more diverse than it used to be in many dimensions, more diverse from the obvious, you know, gender and demographic ways. But also we have more people who are not PhD economists. So we have people from business and law and academia and things like that. So I think you actually do have quite a good diverse perspective. I think all of us read these stories about a lack of diversity, and we look around the room and say, I don't understand. I really don't understand what they're talking about. So, but I get the question, though. Thank you very much.
Well, that's all she wrote, folks. Are we going to dive now? We've been kind of treading water. I think if the market comes back below 505, we might be undoing everything. And my reasoning for that is actually relatively simple. Hang on, we had one alert just go off. Let me get rid of this other. All right, let me dump that. My reasoning for that is simple. It's just I'm watching this green line right here. So I'm using Spot Gamma. Spot Gamma is in the description of the video. I highly recommend everyone sign up. There is a 1-week trial. I know of no other resource that gives you more insightful, useful information into the options market. So anyway, on the screen right now, there's a lot of different lines. The white line is the price line of the S&P 500. What I'm looking at is this green line. This green line is the 0 DTE calls, as in people that have to make a decision of what they're doing with it within the next 30, 40 minutes. As in, it's expiring today. So obviously, when the market started to launch, it was clearly 0 DTE driven. I mean, very, very obvious. 0 DTEs ripped, and the market ripped with it. So what this does is, as people are buying calls, the people selling the calls, the options market makers, because it's a single dealer market, they have to hedge their book. They hedge their book by buying stock. Now we get into a circumstance where all of a sudden, if you have less to hedge, well, what you originally hedged, as in all that stock buying, you would sell it back. So it's kind of a game of who blinks first, because it can cut both ways. If everyone starts to dump their calls, well, the market makers unhedge and the market dumps. But on the flip side, if it keeps going, you can get what's referred to as a gamma squeeze. So it's not just bullish, it's not just bearish, it very much cuts both ways. It's more of an accelerant. It can make a bullish thing very bullish, but it also can make a bearish thing very bearish. So like like I said, the best way I could articulate it is it cuts both ways. So what I am watching like a hawk right now is to see what these 0 DTE players are doing. If it starts to dump, if it starts to go down, and puts also start to go down, as in puts are being purchased, well, the market makers are going to not only unhedge, but they might actually start shorting stocks and close, pushing it down even more. So like I said, it's a game of who blinks first. I'm not of course I'm watching technicals, and I care about the shelf value right here at 505. I mean, we were all the way up at 508. Like, this is just wild. It's absolutely wild. So anyway, this is what I'm watching. The FOMC decision, the bullishness doesn't make the most sense to me. And in reality, it only feels like it's absurdly bullish because of this intraday movement. If you just zoom out to the daily, you're going to realize, oh, wow, we're literally just kind of where we were yesterday. So yesterday was a little extreme, this morning a little bit more, and now we're just bouncing it back. So like in terms of actual market movement in as in a time frame larger than like a couple minutes, I'm literally on the 30-second chart. So on the 30-second chart, this feels crazy. But as soon as you go to like the 15-minute, the 30-minute, the hour, the 2-hour, 4-hour daily, you're like, oh, we actually haven't done much. So I think sometimes the time frame can give you sometimes a more realistic perspective. So yeah, on the 30-second chart, of course we ripped. And then we went flat, potentially shoulder, head, shoulder, who knows? It depends how we react to this neckline. What I'm watching is this 505. I mean, technically it's 505.10, but we might as well just call it 505 flat. But what I really care about is twofold. I care about what's happening with options. I'm going to be watching this green line, but then I also care about bonds. Bonds ripped and then started, it almost was like a leading indicator. Bonds started to dive and then stocks followed. So I was watching bonds as well. So if they start to bounce back, it looks like 80.80 might be important. But on the flip side, if they kind of come through 88.50, something like that, that also could be important. So various things. And right here, I mean, bouncing even a little earlier could be a higher low. You don't know. You never know the next bar. Puts are being closed. You can see it right here in the can you see it right here? See this? See how puts are being closed out? See the upswing in puts? Calls being purchased a little bit, but calls still really flat. But I see puts being closed. So another thing, various things to consider. That's just more stuff. Whoa, that was a pop. Anyway, folks, that's the craziness. Best of luck with the final 35 minutes of the day. I hope you crush it. Whatever decisions you make, I hope you make a bunch of money. And if you're at the point where you know you shouldn't be making decisions, maybe you just shut it down. You don't want to overtrade or get yourself into a position that you shouldn't be in. Well, anywho, folks, that's what I have for you right now. I appreciate you stopping by with the specialty show. If you want, check out Call Sheet pinned to the top of chat. If you want to use my options tool, it's called Spot Gam. It's in the description of the video. That's the one that I by far like the most. Other than that, I'll catch you tomorrow morning, 9 a.m., bright and early. Have a good one. Peace.